Okay, why do I invest in individual stocks and bonds when I encourage almost everybody else to go out and passively index? Well, first, let's look at the case for passively indexing. Warren Buffett himself is one of the ones who actually advocates most people to go out and passively index in like an SPY fund, S&P 500. Now, part of the reason is if you look at any other profession, you would be much better off having the professional do it. You're not going to deliver your own baby. You're going to have an OBGYN do it. You're not going to fill your own cavity. You're going to have a dentist do it. Unfortunately, for the investing professional or the investing profession, the average professional will not outperform the index. In fact, the average retail investor will outperform the average investor, at least after fees, by just buying a low-cost index fund. Um, and this just by definition the way it works, right? If the investing profession as a whole is going to earn the average investment return, which is going to be what the index returns. But I like another quote from Warren Buffett in his kind of seminal piece, Graham in Doddsville. He talks about a coin flipping contest, and many who think the markets are efficient would say, well, you're always going to have the Warren Buffetts of the world just based on a coin flipping contest. If we have 330 million people, of course, some small number are going to outperform. Just like if we all flipped coins in the entire US, 20 people would flip heads 20 times in a row, something like that. But if you found out that we had a coin flipping contest of orangutans and all 20 winners in the coin flipping contest were orangutans that came from one specific zoo in one specific spot of the US, you might say, gee, what are those orangutans doing? What are they feeding them? What's going on here? And I think investing is similar. Who are these outperforming orangutans? They're some sort of value investors. They're some of the guys that I look at as my investing heroes. Warren Buffett, Seth Klarman, Joel Greenblatt, John Templeton, Bob Rodriguez. There's so many great guys who have put out tons and tons of information that investors can learn from. I think the key is, though, you have to be willing to do a lot of research, to do a lot of work. It takes, I think, years of reading and building your foundation as an investor to have the basis for thinking that you can do it. Now, I think investing, it is hard. All the professional investors are trying to outperform, but they've got a lot of short-term pressures. They cannot underperform for a single quarter. They can't. If they outperform for more than a year, maybe 2 years, they'll get fired by their institutional clients. If they do something that looks a lot different than the market, they risk getting fired. For them, the risk is not being stupid, it's looking stupid. So being different from the crowd, which is often a key to outperforming, is a career risk for them, something they can't do. Individual investors like me can do whatever we think is best, and we can take long-term time horizons. So I don't have to worry about underperforming for a quarter or even a year, 2+ years. It's really just what's the long-term track record going to be. The other reason I like to do individual investments is, one, I'm passionate about it, but it's also I've spent my career working on this. So I got interested in investing when I was in 4th grade, delivering papers. Used to follow like a Warren Buffett back then. In college, I was a finance and accounting major. I graduated, got a CPA, worked on my CFA, got my charter. Spent my first decade of my career just reading all the investment grades, reading old investing research, reading write-ups, reading all the legendary investment books. And that gave me a basis for why I think I might be able to outperform or perform similarly with less risk, depending on what a client's goals are. Because I've looked at all these legends and I feel like I can stand on their shoulders to try and get my best investment performance. That being said, there's no guarantees. It's always been like an inoculation for me. I feel like buying a dollar for 50 cents makes a lot of sense to me. And I'm willing to hold something until the market re-rates it or until it pays back via higher dividends, share repurchases, so on and so forth. But I don't think the average investor should be doing it because human psychology works against you. Usually what has worked, what is popular, is often the exact thing you should not be doing. And then what is uncomfortable is often the right move. If you look at 08, 09, lots of investors went to all cash kind of right near the bottom because it was painful, it was uncomfortable, and that move cost them tons of future returns. Fast forward to, say, 2020, everyone was piling, or right before 2020, people were piling in, it felt good. Then in 21, same thing happened. We had a huge rebound right before a drawdown in 22. So human behavior or human psychology often works against you in investing. But I think, when somebody does a lot of due diligence, they're willing to do the deep work, be what, Ben Graham would call an enterprising investor. I do think good returns are possible. And I have either the ego or the confidence to think that that's something that I can do. Anyways, if you're ever curious about talking about my investment approach or what might work for you, feel free to reach out. Thanks a lot.